The Iran conflict is rapidly turning into a defining macroeconomic event. Oil prices are surging, inflation risks are resurfacing, and central banks that were preparing to cut rates are now being forced to rethink their strategy. Let's start with the three scenarios flagged by economists. The base case involves oil prices stabilizing between $80 and $115 per barrel. Growth slows but doesn't collapse, and inflation remains elevated but manageable. Oil pushing beyond $120 would create a stagflation scenario where growth weakens significantly while inflation accelerates. A full-scale disruption in the Strait of Hormuz sends oil towards $150 or higher. That would act as a massive tax on the global economy, sharply reducing demand and tipping major economies towards recession. In all three scenarios, one factor remains constant. Uncertainty is now firmly priced into global markets. For central banks, the predicament is evident. Just months ago, everybody was preparing for rate cuts, but the Iran conflict has changed that trajectory. Rising oil prices are feeding directly into inflation, pushing global inflation expectations higher. Well, this creates a policy trap. Cut rates too early and central banks risk fueling inflation, hold rates higher for longer, and they risk choking already fragile growth. The result is a prolonged period of tight financial conditions, with borrowing costs staying elevated across economies. Well, the combination of elevated oil prices and delayed rate cuts is creating a double shock for the global economy. On one side, higher energy costs are squeezing consumers and businesses. On the other hand, tighter monetary policy is limiting access to cheap capital.